what we started last week. And slightly I will touch on this IFRS 9. I could not prepare the tute for this IFRS 9, but I will share a document, Chartered Institute document. Based on that, we will discuss a little. And next week I will take up that, and we can slightly we can discuss on that IFRS 9 next week also with a summarized version. Plus maybe another question paper slightly we can look at. We can look at a question paper. Then we would be completing our coursework. Then of course you will have to prepare for your exams. That's all will be balanced. Right. Okay. I intend to go on today without a break, so that we can finish early. Because we only will be concentrating on the question paper, and slightly we will be looking. I'll be giving you the basics of IFRS 9 and then the way it is being looked at, and we will do a little bit of elaborate session next week, partly along with the question paper. So that's the plan. So today let's look at. So now last week we started with this question paper, and so we looked at what are the sources of fund for a financial institution, explain the advantages and disadvantages of each sources briefly. We looked at, basically I told you that what is the exam techniques. How do you look at your 3-hour sit-down exam? So how do you allocate your time according to the marks? I wanted you to look at 180 minutes if you have, divided by 100. Not 180 minutes, but leave about 10 minutes for you to go through the paper and then make a mental note of it. Then maybe when you take 170 minutes and then you look at 100 marks, kind of 1 mark you may be spending about 1.7 minutes type of. So that way, every question where 6 marks means 6 into 1.7, like you will have to look at. That's the way. You should not spend more time, because spending more time on a question means you are depriving the time what you have to spend on another question where you would have been more comfortable, or you would have given the time, proper time, you would have answered the question in a much better way than rushing through. So this rushing through, I have seen, that's quite, we all do that, because we become passionate about a question and then we spend time and then we don't know. We keep on, kind of spending the time on that. But then, like what I told you, a 10-mark question, 17 minutes. If you are spending half an hour on that, what happens is that you actually 13 minutes you are losing on the other side. So like that, when you go end of the time, what happens is that half an hour before the allocated time, you will find that there are questions which you will very well answer. You'll do very good answers, but then you actually don't have time. So you will rush through. So scribbling here, scribbling there, and all that. Then what happens is that the marks, desired marks, you will not get, because you have, however much on a 20-mark question you spend time, the maximum you will get is only 20. So not even 20 if it is a written thing, 18 marks or something like that. So there's no reason for you to waste your time with a couple of questions and then go and rush up on the other side. So that's the exam technique what we looked at. So we looked at the importance of this question number 1, because that actually decides whether you pass with good marks or pass the exam. So due to that only we were looking at these ratio analyses and how you look at your balance sheet and then how you answer the questions given, and your knowledge of analysis from a set of ratios what you have calculated. How do you calculate the ratios? And from the set of ratios what you calculated, how do you deduce of the customer standing for a specific loan or facility which the customer requires. And so that your intelligence will come where you are talking about, you are calculating the ratios, tabulating the ratios. And I told you that ratios, when you are calculating, you shouldn't be calculating for 1 year. I see many students do that mistake, because 1 year ratio doesn't mean anything. Because these are trend only we will look at. How the ratios over a period of time improving or deteriorating, and the reasons. So normally when you take the ratio and then for the change in the ratio, you go and look for the reason why it has happened. So like that, I mean, for ratios, you need to have a trend. You have to go by a trend. So year on year, how it changes. That is the trend. So if it is, improvement also, there should be a reason. If there is substantial improvement, there should be a reason. If there is substantial kind of a deterioration also, you need to have a reason. So you basically will be looking at the ratios, calculating and tabulating is one part. On the other side, what do you understand from that? So from your writing, we will understand what do you understand from the ratios. So that's our credit officer's job. Lending officer's job is that what do you understand from that? What do you understand from the financials? What do you understand from the profit and loss account, balance sheet, and then how is the leverage, how is the net profit, operating profit, gross profit and all behaving, how is the return on assets, how is the return on equity, how is the kind of debt service cover ratio, what does it mean, the ratios and all that. I mean, we will understand only when you are writing about that. So you will give a small, with your ratios, you will give a small write-up to say that, I mean, this is what it means. And then in answering specific questions also, that you will show. So that only for the balance now, like, I mean, after, here may 16 marks may involve you calculating the ratios, but the other about 18 marks comes from your, how do you look at the ratios, and then what do you understand basically on a loan proposal. So what are the other documents you will ask for, that kind of thing. So this is a must-do question. Don't ever think that, I mean, you can skip this and then score from the other 3 choices. So you don't think that, I mean, 60 marks are there, so from that I will get through. That should not be an option, because if you are a lending officer, if you are looking at credit management, you need to know how do you really assess a customer, right? Okay, so that's what we were discussing last time. We looked at we looked at the ratios. I made that basically while I calculating. I think one of the student told me, and then I just went on calculating, and then I made a small mistake there. Not adding the depreciation. EBITDA means earning before interest, taxes, dividends and accruals basically. So those things will have to be taken off, because that's what about the business cash flow for you to service a loan. So EBITDA when you're calculating divided by the capital N interest loan commitments. We will annual commitment. We will then divide it. Divide the EBITDA, EBITDA divided by the loan commitments, and then capital and interest commitments, and then that multiples shows that more than one multiples that shows that they have a cash flow that with that the business can meet up with the loan repayment, right? So the more the multiples, more than 1, 2, 3, like the better for the lending institution. So that's about the ratio analysis. So while we are looking at a particular loan, we also said, purely from the ratio point of view, how the business is performing, but purely from the ratio point of view also, we can't take a decision. There are other things are also involved, because you may want to know what is a particular investment, what is their cash flow, whether they have prepared the cash flow for the next 5 years, what is their market standing, what is the demand of the particular product in the market, what is the percentage of market they hold, and whether this particular product is sustainable, or like they are putting up a warehouse or something like that. What is the value addition which is going to bring into the business, saving and all that. And if you are taking a security, what is the security valuation, whether the title cleared, whether survey done, and whether it is a suitable security for to be taken, valuation and all that is okay for the bank to take and all that. So there are many other information also you will ask for when it comes to lending, not only ratio analysis. So that only in the question part number 4 we were dealing with. So those things we'll have to mention, right? So from the point of view of ratios, what you looked at from the financials, you looked at it can be accepted. But if you will ask for more information on the project, on the particular borrowing, for whatever purpose they are asking, on that you will have to ask for, right? Including securities and all that. That's what is about this question number 4 that carries 8 marks. Normally, what happens is that I see students answering question up to this 16 mark, and the balance not satisfactory. That is your, and that's what matters. If you are a lending officer, that's what matters. Looking at financials and then doing a ratio analysis mechanically, you can do. You can also have an Excel program done with macros and all that. You put the figures and then that will throw out you the financials, and then you'll say what is the current assets, current liabilities, what is the working capital, what is the equity, long-term loans, and then what is the total liabilities, total assets, how much, what is the net worth, all that it will show, and then ratios also you can calculate and give, because given you have done a program. But your talent will lies there on making a meaningful deduction out of this particular ratios what you have done. That part only I am seeing that in the 3rd and 4th part of this question. Yeah, how you are able to give your views on these ratios, and then whether it will support the bank going and doing a lending to the customer is what is being looked at there. So that's what is important from a lending officer. And then if you are fizzling out there, the impression of an examiner is low on you, that you haven't done the important part of it. But I see a lot of students really spend the time on doing all the ratios and all that, but then while writing a structured answer on the predictions, on the what do you deduce from the ratios is poor, rather poor, right? So that 10-mark question what I'm telling about part 3 is very important. It's very important. It shows that, I mean, how you have understood, right? So basically, okay, net profit increases, or gross profit increasing is okay. So it is showing an increasing trend. Due to what reason it could have happened? Due to what reason? Let's say that you find that your depreciation figure is going up. Due to what reason? Oh, whether it is due to acquiring new assets, or else any new figure appearing in the balance sheet. What is your kind of understanding from that? I mean, you know, what you write shows that whether you really understand on the balance sheet and P&L, and then your analysis, what you have done on that, whether you are trying to make meaningful deductions, right? So that's about question number 1, right? Now, yeah, any question? Any question from you? Are you all okay?
Yes, sir.
Right. Now the other important thing is that I told you that, I mean, thereafter you have how many questions? After 1 is a compulsory question, 2, 3, 4, 5, 6. So almost 5 questions are there. You are going to choose 3 out of that, right? So quite a good, options. So it's quite an easy task, because you go and select a 3 where you are very confident, and you will write. So it's quite easy, to score from these questions. So question number 2, an asset liability committee plays a vital role in the prudent management of a financial institution. Discuss the composition, role, and responsibilities of an asset liability committee. So you need to structure your answer. You will structure your answer in a way that what is asked there. So you will have to say asset liability committee. What is asset liability committee? Number 1, right? What is the most important function, or what is the core purpose of asset liability committee? Then you will go on to discuss about the composition. What is the composition of the asset liability committee? And then what are the roles and responsibilities? What are they supposed to do? Right? So it's a 10-mark question, so that it's not going to be a okay. So this is a 10-mark question. You can't spend more than say 17 minutes on this. So you will be writing about asset liability committee. So you keep in mind that, I mean, we also have we drew out something asset liability committee. What are the main functions and all that? If you keep it in mind, you will write from that. So asset liability committee is a very important committee of a bank, where it really decides on how the assets and liability to be managed. So like, I mean, there are many functions of asset liability committee, which basically looks at when you are raising funds also, what is the composition on which we raise, and what are the ways to raise. And when you are going for new products also, will have to be approved by the asset liability committee. And they involve with the pricing of all the assets and liabilities, like, I mean, periodically, almost every month, the committee will decide. Not even I mean, like, I mean, even within the month also, depending on the purposes. Let us say in the market there is a reduction of interest rates and then you need to reprice your assets and liabilities. The committee can meet up and discuss and take a decision how to reduce, how to increase the interest rate, what are the products on which you have to reduce, what are the products on which you have to increase, what is the asset liability gap based on the periods. So like 1 day, 1 week, 1 month, 3 months, 6 months, 1 year, beyond. Like how is the asset liability gaps are there. Based on the gap, what kind of a decision we will take to sort of see that, it doesn't expose the bank. So many of these areas are taken in as the asset liability committee. So you will write the the co-function of the asset liability committee is managing the assets and liabilities of the institution, right? So when you talk about the composition, you will have to talk about the composition. Basically, board level ALCO can be there, or else management level ALCO can be there. When it's in the corporate management level, at the management level means what happens is that the CEO will be the, if it's a board level, chairman will be the chairman of this committee too, or else at the management level it is the CEO or managing director will be the chairman of the committee. And then that there has to be CFO has to be part of it. The treasury department, you have treasury front office, treasury back office, they will be part of it. And then you have business heads, whether you're retail banking, whether you're corporate banking, they all will have to be part of the committee, because they are the people who are involved with customers in dealing with the assets and liabilities of the bank. So they are the composition. And then roles and responsibilities basically is what we were talking about, right? That plays the central role of managing the assets and liabilities of the institution. And then responsibilities are multifaceted, like pricing of the assets and liabilities, maintaining capital adequacy, maintaining the risk, right? Ensuring that the bank is complied with the regulatory requirements when it comes to capital and maintaining different what do you call statutory reserve ratio, statutory liquidity ratio, all that maintaining statutory reserves. So these are all the responsibilities of asset liability committee, which we have very elaborately we have discussed, and then we have given in a by way of a what can I say? There is a diagram which is given. The diagram explains to you basically what are the functions of responsibilities of ALCO, Asset Liability Committee, right? So, you can't write a lot here. You should know within 70 minutes how much you can write, right? So somebody can write about 1.5 pages. Somebody will write 2 pages, or somebody will write 1 page. Doesn't matter so far as we cover the area, right? Cover the area basically, what is the co-function, how it is composed of, what are the responsibilities of Asset Liability Committee. That's it, right? So that's important. Now, then the next question is that what is deposit insurance? We learnt about deposit insurance. Deposit insurance, of course, is a insurance scheme created and kept under the purview of central bank under a particular statute which we discussed under the particular central bank regulations. And deposit insurance, what does it mean? It means that if there is a problem And if there is a bank run, and if the institution is unable to, kind of a bankrupt situation, unable to meet with the deposits of the customers, pay back the customers, like what we saw in various finance companies in the recent past, then central bank will pay the minimum amount guaranteed in the deposit insurance. Currently, it has been increased to 600,000. So per customer, they will pay 600,000. It basically is kind of giving comfort to the small depositors, right? People who are having small deposits. So customer can have any amount of deposit, but then through this deposit insurance, they will get 600,000, right? 600,000. So you will have to say what is deposit insurance. So deposit insurance is a insurance scheme created by the central bank under the regulations of the central bank to safeguard the interests of the small depositors. So the amount currently paid under this scheme is 600,000. So if you remember the particular kind of the statute or the guideline given by central bank, you can quote. Otherwise, it's not that mandatory. But if you really write what is the purpose, what do you understand by deposit insurance, and how a deposit insurance is created? Because deposit insurance is central bank scheme where banks on their liabilities, on the deposit liabilities, basically will have to calculate how much is the deposit liabilities and on which a premium has to be periodically paid to central bank. It's kind of a one-off premium. Now let us say last 6 months, it's almost a 6 monthly premium should be paid. Last 6 months, a financial institution has paid, for example, let us say 10 million premium for a, let's say they had say 300 million, just for example, 300 million deposits they had, and they paid a 10 million premium. Now, if the deposits have increased to 350 million during the next 6 months, on the 350 million, now they will have to pay insurance premium for the extra 50 million. So that's how the calculation will go. So the 50 million additionally they will have to pay, right? So depending on the increase, additional premium you have to pay means you'll calculate and pay. That's how it will go. So every time they'll take the average balances and then they pay the deposit insurance premium paid by the financial institutions or banks, right? Then depending on the circumstances, central bank will step in to pay the depositors if the institution falls into trouble. So that's deposit insurance, right? Paid under the scheme, and under what circumstances means if the financial institution faces difficulty, faces a bank run, faces difficulty in settling the customers' deposits, at that point only central bank will step in, right? Okay. The next question is, what is a credit policy? This is a very important question for you, right? Why it is important for a bank? Because a credit policy is the live wire for a financial institution for the lending, right? So the credit policy will spell out financial institutions' appetite. So what they are looking at while they are doing lending, what is the quality of lending they are looking at. So what is the policy of the institution, right? So there will be a lot of sectors will be there, how the sectoral exposure will be looked at. Every sector, how much of exposure the institution will look at. If the sectoral exposure exceeded what they are supposed to do, whether are they going to stop or whether they are going to have additional measures so that they mitigate the risk, kind of, those are. So the credit policy of a financial institution spells out what this financial institution, what is the standard the financial institution is going to follow in their lending practices, right? So um, so that's about the appetite. Then the procedures to be followed, like that also will be spelled out. What is the procedure in doing a taking a credit? What are the procedures to be followed? Like, I mean, how it is. Like, I mean, there are many institutions which are doing centralized credit processing. There are decentralized credit processing. State banks and all. You know that, I mean, largely it is decentralized. Basically, the branches itself, everything is processed and then dispersed and then followed up and all that. There are semi-structures are there amongst private banks. They partly do at the branches and then partly do at head office, a process at head office. So that is it's a kind of a hybrid structure. And there are foreign banks which only do centralized process. Branches are kind of functioning as a kind of a post office. They will take from the customer and pass it on to head office. Head office will process everything, right? So it's all done centrally. So there are many structures which are followed. I mean, that will be spelled out. What is the credit, lending structure which are followed by the financial institution, and then um, look at the approval structure, how the lending, like, I mean, what kind of authorities are with the branches, branch lending officers, and thereafter head office officials, and then what are the committees which are dealing with this. You have your above your branches, you have your regional setup, you have your corporate management, AGM, DGM setup, you have your executive credit committee, I mean, a similar committee. In that committee, a few of the corporate management members will present, like agents, DGMs, and MD and all that. And then you have board credit committee and board. So what are the limits of the board? What are the limits of board credit committee? What are the limits of executive credit committee? What are the limits of the CEO? The corporate level officers like DGM, AGM, and what their limit underneath regional office, regional managers, what their limit lending authority. All that will be spelled out, right? All those things are. So the credit policy is that. So you will have to briefly write about these things as a credit policy. But then 5-mark question, keep in mind, you can't write a lot, right? You can't write a lot, and you can't spend much time, because you are going to spend about 8-9 minutes only maximum in writing. So based on your writing speed, you will have to briefly say that what is a credit policy, what is important, why it is important for a bank. Because if a bank doesn't have a credit policy, it doesn't show to the lending officers what the bank wants to do, or the financial institution wants to do. It doesn't give any direction to the lending officers. It doesn't give any direction to the internal audit people to go and check, whether lending has been properly done. It doesn't give any direction to the central bank auditors to come and look at. So whether they need to have a standard there, whether the bank is meeting with the standards. The standard is spelled out in the credit policy. So it doesn't give any direction to the external auditors also when they're doing the annual audit or monthly and annual audit. They also, I mean, for everything, for all this inspection, internal audit, external audit, central bank, everybody will look at what is your policy. What is your policy? So they will come and look at what is your policy, and then from the policy only they will say, okay, how much have you adhered to the policy? All your lending is in accordance with your policy, or whether you have deviated. If you have deviated, for what reason? So whether you have proper authorization for deviating, those things they will look at. So if you don't have a policy, you can't check anything. Anything is okay, like, right? So you go and give to a drug addict, drug peddlers, you go and lend, it will go as okay, no problem, because there's no policy, right? So it's like that. So you need to have a policy for every one of these people to go and see that you are complying with the policy. So the credit appetite of financial institution will differ. You have seen in the market, maybe the finance companies go and lend to the, that's a lending model. Like, you look at three-wheel drivers and all that. Three-wheel purchases and all that. There are a lot of leases are being given. But if you look at the bank will curtail that. Bank don't give. That's a risk appetite. So maybe the banks are looking at, these are high risk and not to go and go into that. But on the other side, those give high return, so that will conform to the standards of finance companies, because finance companies are also operating with a high cost environment, because they will be borrowing from the market and then doing leasing. So going and lending to sectors of that nature and then getting a higher return makes sense for finance companies. So like that, these are all credit appetite. Oh, that's spelled out there, right, in the credit policy. So like what I told you earlier, there is, with the credit policy, some of these financial institutions, they have a lending guideline also. The lending guideline is something which will keep on, that is a supplementary document to credit policy. The lending guideline will keep on changing. Let us say, lending guideline will tell you what are the documents to be taken. Now, like, when there's import policy is changing, what should be done. Frequent policy changes, frequent instruction from the management, it's kind of a dynamic type of a thing, so those things will be factored in the lending guidelines, and credit policy will change very infrequently, right? Unless there is something, a policy level change has to be done. Credit policy will remain, constant, and with less frequent changes, and lending policy will keep on changing, right? Depending on the market conditions, as well as the bank's decisions as and when it changes, it reflects in the lending. So it's a supplementary document, right? Okay. So go ahead. Yeah, please go ahead. Somebody want to speak? Okay. So not that every institution has these lending guidelines, don't worry. So credit policy, what is it? If you understand, that's okay. Any question here? Any question? No questions? All right. Shall we go to the next question?
Okay, sir.
Okay. So why do different lending products carry different interest rates? Right. So can one of you have the speaker on and then tell me, why do different lending products carry different interest rates? What factors are considered in pricing a loan?
The cost of the granting loan and the risk of the loan type.
Cost of funds.
Okay, cost of funds. Why do different lending products carry different interest rates is Okay, cost of funds is one. The other one, what the other student mentioned.
To cover the mismatch.
To cover the mismatch. Cost of funds to cover the mismatch. And then?
Associated risk.
I didn't get you.
Associated risk.
Associated risk, yes, you're right. Yeah.
Collateral.
Collateral, yes. So all what you say is correct. All what you say is correct. So lending products, why do have different interest rates? So the pricing of a loan we have discussed elaborately. Pricing of a loan is very important for a financial institution. So in pricing of a loan, you have so much of considerations going into that. So as you correctly say, in pricing of a loan, you will look at your security cover. For example, when you have a more liquid security cover, you will tend to give a lower rate because your risk is less, right? That's why for deposit, cash facilities against deposits, when you are giving loan, you are trying to give it with a small difference, right? Small percentage difference you will try to give because there's a default, you will immediately recover. Then against property mortgages, your rate will be attractive than compared to other stock mortgages or whatever. So the pricing, you basically we look at the security cover. That is one part of it. The other one is what is the level of in the sense what is the tenor, right? For what period you are going to give the loan, for what purpose you are giving, because for the purpose what you are giving as these risk levels, right? Say that is the very reason why you are looking at credit cards. Means you will go and charge a high interest rate for credit cards for the simple reason the risk levels are high because it's a very less evaluated unsecured lending where the risk levels are high, so you charge a high amount. So based on the risk, you charge a high rate, right? And then you have the cost of fund of the institution matters. Why for leasing and all that finance companies should charge high, and then why the banks are charging low comparatively is that cost of fund, right? Because over and above the cost of fund, you need to make a profit. So that's why what we were discussing earlier also, like some of the risky sectors also, finance companies might have more appetite than the banks for a simple reason that, that is based on the cost of fund. Because now if they are to go and give to the formal sector, they may not be able to match the interest rate. Right. For example, let us say you are going and lending to John Keel's Holdings, and then finance companies can't go and lend to John Keel's Holdings because they will ask rock bottom rates, which can't meet. Sometimes what the rate at which the finance companies can raise funds in the market, John Keel's Holdings can get lesser rate than that, right? A good corporate can get a lesser rate than that. So that is the cost of fund, right? So the cost of fund, the purpose, the tenor, the security level, right? So all these will be considered in pricing a loan, right? So unsecured means when you charge high for personal loans, you charge high, right? If it is a gold loan, or like central bank also is governing now, and then the rates are really down on that 9%, 10%, like, I mean, you know, because the risk is less there, right? In the same way, if you are involved with corporate lending, so the corporate customers will ask for somewhat close to or equal to or extremely extreme cases even lower than the PLR, average weighted prime lending rate. So those prime lending rates are basically taking about 10 you know, lowest rates given by top customers with a good rating given by different banks and taken in central bank calculation gives the PLR. So the average weighted average PLR, that PLR currently, last week it was 5.98, 5.90, I suppose, 5.90. These banks will ask for 5.9. Companies, these companies will ask at 5.9 or less than 5.9. Right? People will ask for it at 5%, 5% also, 5. So it all depends. I mean, why the corporates, even without any security, they will ask for? The reason is that default risk is less, right? There are many lenders vying for those customers, so they have the bargaining power. So the interest rate, pricing of the interest rate, that is considered. The corporates of less in the risk rating, their risk rating is lower, right? Solid companies. So for them, you price it at a lower rate. But at the same time, for a customer, retail customer who is giving a security also, you may be pricing high, right? Somebody from whom you are taking a mortgage bond, fully covered mortgage bond also, the pricing may be high, right? That is because of bargaining power. Right? Personal customers, retail customers, they have very less bargaining power compared to these corporates, right? So those factors. Right? So you will write very brief answer here, right? So what are the things what we discussed, like, you know, the cost of fund is important, the purpose is important, the tenor is important, right? So those areas you will have to mention as the factors in pricing a loan, right? The customer profile, right? That's what we were talking about, personal customer, retail customer, and corporate customer, all that, you know, profile of the customer also. Okay. Any question there? Are you all okay?
Yes, sir.
I don't hear from any female students. You all are participating, I hope, right? Normally in a live class, I used to see that ladies used to be very active. They used to, like, you know, very actively participate. Maybe on online class, I don't see that much of a participation, right? The next question: why the valuation of a property to be mortgage important? What are the ways in which a valuer expresses the valuation of a property, right? So these are very simple questions, right? So you take a valuation of a property to ensure that the property which is mortgaged has the minimum required value. Like, I mean, if you are taking a mortgage for 50 million, you must know that, I mean, it has for sale value more than 50 million, right? Otherwise, what is the point of taking the mortgage? In a distressed situation, if you have to sell that, that should cover the loan what we are giving. So the valuation of a property to be mortgage is important for us to decide on the mortgage what we are obtaining, the value of the mortgage what you are going to obtain. So what are the ways in which a valuer expresses the valuation? We looked at, I mean, you know, valuer will look at, and what are the considerations going into the valuation we looked at. After that, they will give a report. So valuer expresses the valuation of a property by way of mentioning all the, they will mention about where the particular asset, and then whether it is a right of way, whether it is positioned in a proper place, and then of course they will express taking various things into consideration. They will give the valuation, like, I mean, this is the market value of the property, and then this is the for sale value of the property, right? So they give 2-3 valuations. What is the other one? One is they give this for sale value as the distress conditions. The market value they will give, and then the insurance value also they will give. If there's a building, and then bank will have to go for insurance policy on that. Let us say for fire policy, we have to go for insurance value also mentioned. What may be the market value, but then in a distress situation, bank cannot go for market value. Bank will look at the for sale value. So for sale value is that at any point of time, what is the rate at which you can sell that property, right? For parata execution and all legal case, if you are going for, that's very important. So those that's the reason why you are going for valuation, right? Right. Okay, those are brief answers you can give on that. What are the important warning signals one should consider to proactively prevent a loan or overdraft from becoming a non-performing asset? So I think we last looked at these warning signals. Warning signals for you to consider. One should consider proactively prevent a loan or overdraft from becoming a non-performing asset. Now, why warning signals are important, why you should follow the warning signals, and why you should take action is that sometimes it can be a proactive measure for you to prevent from something becoming a non-performing advances. So if you don't really follow, I just wait for customer not to pay 2-3 installments, 3 installments not paid, is going to be NPA, then running to the customer. By the time you will see a lot of things have happened, customer has gone out of business, kind of the shopping where the business is kind of shows a very much less activity, and customer is struggling with so many other things, like borrowed funds unable to pay, his suppliers is unable to pay, right? His creditors is unable to pay, like, I mean, so many other difficulties, and then the recovery of the loan is remote. So that's the reactive measure. So proactive measure is that following up on the warning signals and then trying to take rectifying measures. So the warning signals comes in various ways. So you look at the customer, and many of the warning signals are there. Maybe the customer is slowly becoming not settling the monthly loan installment. So when you try to call customers is not answering. Normally he will answer, but he is not answering, right? So call is getting forwarded to somebody. They say that, I mean, eternally boss is not there, or the finance accountant is finding excuses, right? So that's a warning signal. And then you ask for financials. Financials are getting delayed. And you also ask why you are getting delayed. They tell you different excuses. Not a good sign. So somebody who is taking time to prepare financials, and then normally when they are giving on time, and then when they are not giving on time, there are other issues there can be. And when you look at the account performance, if you find that your credits are, the credit to the account is going down, but debits are going up, and then the other day we saw the round figure checks are frequently presented means, okay, there's a warning signal because customer is borrowing from elsewhere and then giving round figure checks to those informal money lenders. It may be true, it may not be true, but rather better to look into this and see why it is. Why the turnover is, credit turnover is less. So credit turnover is less means turnover, like their sales turnover is less. Sales turnover less means business is going down. Why business is going down? What is the problem? Whether he is not settling the suppliers, due to that he is not getting the goods in time. So those, like, I mean, you know, from the accounts you will find out, I mean, there is a problem, right? So if any key officials from the firm, they are leaving, key officials from the customer's company leaving, so why they are leaving, right? There can be a reason that, I mean, there's some problem, or unable to continue, they are leaving. Now that every time it is true, but still for all, when you find out that as a warning signal, you need to probe a bit more into that tendency, but check and see. So we need to have connection with the people around also, and then see what's happening. So those are proactively to prevent the loan overdraft becoming non-performing asset, right? So anything more you would like to contribute? More than that? So these are core credit areas. So you should know, looking at the warning signals and acting upon it, that is a regular work of you know, people who are involved in lending, recoveries, right? Even before recoveries, the lending officer should know. Recovery is a reactive measure. Proactive measure is that while the advance is performing, while in the performing section, you just look at it and then, you know, identify any warning signal and then go and try to rectify, right? So if a customer, when you see that the turnover is down and all that, I mean, we need to reduce the working capital facilities. There's no point in the customer having a high working capital facilities where he is not having the turnover to that, right? So how other mitigatory factors we have to look at, right? Talk to the customer and suggest the customer that, I mean, you know, currently the other loans also, if you are not able to pay, like, what is your current you know, cash flows, based on that you need to restructure this, right? And you know, paying, and then the other things are like, I mean, you know, siphoning off the money. Money is being invested in some other, like money is being invested into share market. You can identify that when the cash flow difficulties are coming. You can identify that my money. That's one of the reasons why you look at the current account hardcore portion. Why hardcore portion? Because some money has gone into a purpose which is not generating more. The turnover is not coming here, right? So that's where we said that, I mean, hardcore portion you will have to convert into a term loan. Like that, I mean, there are many warning signals as a lending officer who should know, look at, take, proactive. Keep in mind, proactive measure. This is not reactive measure, this is a proactive measure, so that you will prevent a loan or advance or a composite facility going into non-performing asset. Any questions here?
So what does it mean by hardcore formation?
Okay. All right. Okay, let's look at it. Can you see the board?
Yes, sir.
say a current account, let's say you are giving a overdraft 100 million. 100 million overdraft you are giving, right? This is overdraft. Give 100 million overdraft. Now what you understand basically is that, so let's say that the customer is giving 1 month credit period, right? To his debtors, he is giving 1 month credit period. So 1 month credit period, if he gives, your basic understanding is that customer balance is here. Above this, this is minus, above credit, above plus, right? Okay. So customer having a credit balance. Let us say customer having a 5 million credit balance, like that. So he is having a balance here, and then he is giving this 100 million. He is using the overdraft facility, and then let's say 1 month. 2 months, 3 months, 4 months, let us say. Now, if he is giving a credit period of 1 month, within 1 month, what happens is that his credit should come in. So, he has taken working capital, and the goods are processed and sent, and 1 month credit period given, he should get the customer's credits to him. Right? It comes here. The sum of credit goes down. Right. This is the way your current account has to operate. Current account will have to, come to credit, go to your limit, and come to credit, and go to your. This is how your current account should work. But what happens is that your current account, if you look at your current accounts, so let's say this is a OD. When you look at, here you are giving excesses also. When you are giving excess over limit, let us say. Now, current account, this is what it will operate. But what happens is that when you don't really follow the customer, observe the operation, and control the customer, what happens is sometimes the customer will, okay, this is all right, this will happen first month. And it can go, the credit might come, and thereafter it comes here. All right, OD taken, and the credits are not coming, right? Credits are not coming. It doesn't, account doesn't come to the credit, and it goes here, and goes here, and goes here, and here, and all the time like this. That means all the time here, after here, it is operating above the limit. So this is, then what happens is that from here onwards, you will see the credits have to come to the account as not happening, right? Credits, only part of the credits are coming. And then slowly it goes down, and then it comes to the particular overdraft limit. The customer is operating at the overdraft limit of 100 million, 100 million, 100 million. All the time account is, and then he comes and asks for TODs, above the limit he operates, TODs and all that he asks for here. That means this 100 million has become hardcore. Then at this point it has become hardcore. It's called hardcore. Why hardcore? Actually, working capital, even working capital currently being used up elsewhere or something in the business, and the customer is operating above the limit only, at the limit or above the limit. It's a problem. This is called hardcore. This is what I was telling that time to time when you look at it, and then if there's a hardcore formation, tell the customer that you need to operate the account. Your current account has to be operated with wide fluctuations, in line with your working capital requirements, because we have provided working capital requirements. If the credit is not coming, there's a problem, right? So identify and then convert this into a term loan. You will convert it to a term loan. If it is operating at this level, we will We will talk to the customer and then try to convert this part into the term loan. Like that. So you convert into a term loan the hardcore portion, and then whether if he is operating all the time here, then 100 million itself has become hardcore. If it is somewhere here, let us say about 20 odd million has become hardcore, 25 million has become hardcore. Now, if the customer doesn't operate with wide fluctuations and operating somewhere close to the limit given or dwelling there, that means there is a problem with the customer and the fund has gone elsewhere or he has lost in his business. So we can't, because overdraft giving a limit and then the customer operating at that particular limit is a risk to the financial institution. Why it is a risk? Because he is not repaying the capital then. He is only paying the monthly interest and then keeping this. So maybe there is no plan to settle this, right? Working capital given used for something else. Understand?
Yes,
Are
sir.
you okay? You okay?
Yes, sir. Thank you.
Okay, so we looked at this third one in the third question, third part we have looked at, right? So we are going into, for a financial institution, question number 4, part 1. For a financial institution, raising funds through customer deposit is always sustainable fundraising method compared to borrowing in interbank market. It's a 5-mark question. So give you answer. Tell why we should think that raising customer deposit is always sustainable fund raising compared to interbank market, borrowing from interbank market. Why? What is the reason? Yes. Speak on your mic and speak.
Customer deposit can get various period, but interbank it is short period.
Okay. Customer deposit comes for various periods, and interbank is only for kind of a fixed period. Right. One answer. Anybody else?
Customer deposit provides more precise direction to make decisions.
Customer deposits
Provides a better direction to make future decisions.
Okay. Customer deposits provides avenues to make better decisions. All right. Any female student? None of you all are speaking. I don't know whether you are listening or not.
High interest rate.
Yeah.
High interest rate.
High interest rate. Yes, one of the reasons. High interest rate is one of the reasons. Yes. That's it. Right. Now, when you are raising deposits, deposits we are raising through various ways. Like, I mean, we have so much of products, very diversified products we have, right? It can be CASA accounts, it can be current account, savings account. In savings accounts also we have various products, whether it is a generic savings account, whether it is a senior citizens account, whether it is the teen saver accounts, I mean, in the sense, I mean, minor accounts, right? Youth account, all sorts of, we have so much of products when it comes to CASA accounts, and then fixed deposits of various tenors. So we have a multitude of products. So what happens is, what is the most important thing you should understand is that while having deposits, our deposit base consists of a huge number of depositors, right? So no one depositor can really make a shake. By withdrawing, he can't, you know, change the composition, right? So we have a huge number of depositors. So that number of depositors really giving a comfort to the financial institution, where one or two customers withdrawing is not going to be a problem. Number one. Number two, cost of fund. The cost of fund is managed by having this multitude of deposit products. Like current account, you don't pay any interest. Savings account, you pay the lowest interest rates, right? Various other savings products are there, like, I mean, here and there, like, I mean, we spice it up and give a bit of a high rate, but we manage it when you take the whole portfolio, right? Fixed deposits of various tenor, right? And then for stability, we have minor accounts, which is running into 18 years, like, I mean, maximum 18 years of deposit, you know, continuing. Because if somebody is opening an account for a child, just born child, until he becomes 18 years, probability of the continuity of the deposit is there. So that diversity is there when you're having customer deposits, right? Customer deposits. So that the customer deposits gives you stability, sustainability, right? And interest can be forecasted, basically, right? This is the interest rate, this is the average interest rate for the bank, average cost of fund and all that. But when you take an interbank deposit, borrowing from the interbank, when you borrow from interbank, it is only, you know, short term. Long term interbank borrowing is very rare. Banks don't lend, you know, long term in the interbank market. It will be short term and very competitive rates. It depend on the market conditions. And then, I mean, one or two deposits when you one or two borrowing. So the thing is that, I mean, that is not stable, not sustainable, right? That's not stable or sustainable, because that's for emergency we can take it and then we'll give it back, right? The comfort, the sustainability, the rate advantage, the the shocks, what it can impact, what it can create, and all that. When you take all that into account, the deposits are much more reliable, sustainable, and easy for continuity of the operation. Then, what do you understand by HQLA? High quality liquid assets. In talking about liquidity coverage ratio, net stable funding ratio, is coming under Basel III. We have spoken about this high high quality liquid assets, right? So high quality liquid assets means liquid assets which can be converted into cash. Liquid assets which can be converted into cash very fast, instantly or very fast, which can be converted without loss of value, right? It's not like, you know, discounting or whatever. I mean, you can convert without loss of value. So that's high quality liquid asset. High quality liquid assets which can be turned into, which are liquid and turned into cash without losing the value of the asset, right, at any point of time. So your liquidity coverage ratio, you will look at your 1 month outflows. You must have liquidity to cover minimum of 30 days of your outflows, right, by way of deposit repayment or by way of loan disbursement. So for that need to make a calculation, and this is what will be the outflow for the next 30 days. For the next 30 days, you must have liquid assets, right? HQLA, so high quality liquid assets. So high quality liquid assets is the value can be converted to cash without losing the value. Right. The other one is what is single borrower limit? Discuss the current limits and applicable to an individual and a company. So we looked at single borrower limits elaborately. You have a tutor on that. So single borrower limit basically is 33% of the capital of the financial institution, right? And for company with like, I mean, a group of companies, individual group of companies, there is a small calculation I gave you depending on the bank's rating, depending on the customer's rating, and it can go up to 33% to 40% also, provide the banking rates or bank's rates, and then customers rating also high. And I gave a matrix to you. Under the matrix, we said, I mean, under this matrix, we will go up to 40%, but normally 33%. It can go up to 40%. So the matrix, of course, you can just look at it, and then you must keep that in mind, right? Under what circumstances it goes. So that only you will have to discuss when you are talking about the single borrower limit. Any question? Next is write short notes on any of the four. You can select 4, and then there are 5 given. Other you select 4 and then write short notes. So here also you will note that, I mean, everything is a 5-mark question. So on 4 you will have to write, so that you must be mindful about the time you spend on each and every one of these. So parate execution rights we looked at. Under what statute parate execution rights are given, who are the people who are eligible for parate execution, what does it mean, like under what circumstances you can exercise parate execution. So we also looked at parate execution cannot be exercised if it is a third party mortgage, if the value is less than 4 million at the time of the action, if the capital plus interest outstanding, if it is less than 4 million, you can't, right? It should be more than 4 million, and it should be the first party, third party mortgages what you have taken, you can't. And then we also looked at some of the companies on which, I mean, based on the fact that these are private companies, and then we are the owners are the directors whose personal properties are mortgage, means whether that you can go for parate on that, or whatever the court's decisions recently that you can go for parate on those things, right? That also we looked at. So parate execution rights is that, right? You will have to write on the parate execution right. So net stable funding ratio, I think the liquidity coverage ratios, net stable funding ratio, also in the next I'll include in the slides also for you to see. So we looked at anyway, net stable funding ratio, basically you are talking about 1 year's outflow, 1 year's outflow, and then the coverage, right? For that the coverage by the financial institution, right? So whether gaps are properly managed. So 1 year's outflow, and then whether inflows are covering the outflows. So that's the calculation which shows net stable funding ratio. Liquidity coverage ratio is 30 days of cash outflow, for that whether we have HQLA, right? High quality liquid assets, whether the institution has to cover the outflow for the next 30 days. That's liquidity coverage ratio. So the purpose you will have to write, and then that part shortly you will have to write and explain a stable funding ratio. Okay. Equities and debentures. So this is a contrasting thing. Like, I mean, equities versus debentures you have to write. So what is equity? What is debenture? So we looked at equities. Equities basically is a equity capital, right, of a company. So debentures is a loan capital, right? Capitalizing by way of loans, debentures. So when a bank is issuing equities, what are the repercussions? When a bank is issuing debentures, what are the repercussions? So when you are issuing equity, the cost to the company is that, I mean, issuing that administrative cost and all that will be there, and thereafter it is the bank's or the company's discretion at which, based on the profits, dividends will be declared. Dividends may not be paid also. Like now, central bank itself has put government itself has put a ban on giving dividends. You said, I mean, for the until you are publishing your accounts, don't declare any dividends, right? So for all the banks, the government has given the instruction. The central bank, through central bank, instruction has been given not to declare any dividends. So equities, of course, declaring dividends and paying the dividends is the decision of the institution. But when it comes to debentures, debenture, of course, interest has to be paid. Debenture, that is interest, right? Interest portion has to be paid. The guaranteed interest should be paid, right? So until the maturity of the debenture, the guaranteed debenture interest should be paid. That's mandatory. So whether the company is making profit or loss is not an issue, right? Debenture interest should be paid. If debenture interest is not paid, then the company is in default of payment, right? Actions can be taken. So the debenture is a loan capital, right? So equity capital and loan capital. So that, I mean, the debenture interest payment or the redemption payment of the capital amount and all is responsibility of the corporate. They will have to pay the debenture capital on maturity. debenture interest periodically has to be paid, right? So equities basically strengthens the equity part of the company, but debentures only will increase the loan capital of the company, right? Is loan capital of the company. So equity is in a way good for the company because you know, that is strengthening the equity, but while the cost is not going to be there, I mean, that will be confined to the dividends what is being declared, but debentures are not like that. Why equities are debentures are preferred for a different reason. And then debentures are preferred because that part I told you all, the debenture, when they are paying the debenture interest, you know, interest, that in the profit and loss account, you can charge the profit and loss account, right? But dividends, what you pay, if you look at the accounts, dividends are paid from the after-tax profits. Net profit after tax calculated, and from that only dividends are paid, right? Equities, dividends are paid from the net profit after tax. So you know that net profit after tax is the final figure in the profit and loss account. From that only dividends will be paid. So that means the company first pays the taxes, and after that tax paid amount only can be distributed among the shareholders. But when it comes to debentures, you're taking a debenture, you are paying debenture interest, and debenture interest can be, you know, charged to the profit and loss account. That is before the in the overheads it will be charged, right? After the operating income, you can charge the debenture interest, and after deducting that only you are arriving at the net profit, and the net profit taxes are paid, taxes are reduced by that amount of debentures what you are paying, right? So because you are arriving at that profit figure after paying the dividends, debenture interest, sorry, debenture interest. So those are the differences. Did you understand or not? You don't have to write a lot, but anyway, I explained to you. Did you understand the last point? Are you okay?
Yes, sir.
You are okay, right? So we looked at this particular, you know, tax effect on the you know, dividends and debenture interest. For that reason, even you know, in the Western kind of courses and all, you will find that, I mean, they prefer the debentures because your finance cost will be less, kind of. Right. Venture capital companies. What is a venture capital company? So this is, I told you, is very important one also. Venture capital companies. How a venture capital company differs from the financial institutions, banks and finance companies and all that, and venture capital company. What is the difference between these? Right? Any one of you tell how venture capital company differs from finance, normal bank and finance companies? Yes, go ahead. Tell your views. What do you understand by venture capital company? How does it differ from bank or finance company?
venture capital companies are providing support to start up the business, but also they are not providing only the financial services. They are bundle a package such as marketing services and other business supportive services. And from the beginning of the facility, they are providing their support until the project is finished.
Okay, right. So venture capital companies are quite different from the banks or finance companies, because we are all concerned about looking at a business and then we will go and give a loan and that's it. I mean, making the business success and then generating cash flow and then meeting the commitment is customer's part. So as far as we are concerned, we are given a loan, you pay. That's all matters to us. So if you don't pay, we will take action to recover. So that's the same model when it comes to finance companies also. So if you are leasing an asset, lease payments are not paid. Leased asset are also forfeited, right? Confiscated from the customer, and so like that's the model on which the banks and finance companies work. But the venture capital company, what they are supposed to do, what they are doing, is quite different in a way. It's very startup business friendly, entrepreneur friendly. In the sense, I mean, they handhold entrepreneur and then take them forward. Now, let us say somebody is having a very good technical know-how, and then he's on to some product, but he doesn't have financial support. And maybe, let us say, he's a computer wizard, computer engineer, is developing, for example, let us say that he's developing a portal, online portal or something he's developing and all that, but then he actually doesn't have business knowledge, he doesn't have funds, and he doesn't have sufficient assets, right? So a venture capital company, if he goes, if they see that whether the business is a workable business, they will see that, I mean, whether the formula what you are bringing in, whether this is a workable thing. And then if they are satisfied, the analysts, they will look at it, and then if they are satisfied, then of course they go to the extent of taking equity partnership. So equity partnerships, the venture capital company takes in that company, goes and invests, means they will look at the other aspects of managing the business, like providing necessary advice on the finance and management side of it, and handhold the entrepreneur to sort of work and then bring the product into production and then generate the cash flows and all that. So the moment the business is becoming okay, so their agreement will cover all that, how their return is going to be. So once the business is doing well, it comes up and doing well, the venture capital company will have a exit strategy also. So they can exit by selling the shares. I mean, they would have taken shares in the company. Part of the shares they would have taken. They can sell off their stake to somebody else or to the owner himself. They can sell it to, or else they can go for IPO, initial public offering, and sell their shares and then exit, right? So, or maybe partly they will divest and then partly they can keep with them. So many ways, I mean, they will try to get their return from that. So this is quite different from the way banks and finance companies operate, where we are actually giving the capital, and it's always goes by way of a loan. And if the business meets with a loss, we will hold on to the security and try to recover. So there, of course, if it's equity participation, if that concept did not work, if that concept failed, and whatever investment becomes kind of unrecoverable, then whatever invested by the venture capital company also will be a write-off to them. So that is the risk. And so venture capital company business is a high risk, high return business. Right? Some of the businesses really do really well. They perform really well, and then that gives a very high return. So I have seen many businesses. One of the examples I told you all, this Millennium IT, when they started in a very small way, and when they developed the stock exchange software, that software they developed, and then they sold it to Colombo Stock Exchange, and that is the software still even now which is being used for the more than 20 years now. So that then they became experts in that, and then they developed for various countries the stock exchange software, and then gave it, and then they became very big. So their shares were sold, their stake was sold by the venture capital company. I mean, where initially I knew that one venture capital company where they invested 50 million, and then they sold their stake for 450 million. So those days, 25 years back, getting a return for 50 million investment, a return of 450 million, that means 400 million additional, means that was huge, right? That was huge. Even the bank's total profitability, kind of big bank's profitability was in that range. So such is the power of this venture capital company. But in Sri Lanka, the venture capital companies are so very far in between. It has not really developed. There are only very few venture capital companies like Lanka Ventures of DFCC. So like venture capital company operation is very much less, and that may be one of the reasons why in Sri Lanka you don't get a lot of entrepreneurs coming through flourishing, because I mean, through venture capital companies, somebody who is from a very low level should be able to rise up to become an entrepreneur, right? So that not very much happening in this country. Maybe one of the reasons is that we do not have venture capital companies really operating in the market. Right. Okay. So that's about. Any question there? Any question there? The last question is that credit evaluation plays a vital role in maintaining a quality lending portfolio. What are the factors to be considered in evaluating a credit proposal? Right. So these are your core areas. So what are the factors to be considered in evaluating a credit proposal? What are the factors you will consider? Right. So it's very easy. So tell about every student, tell about one, and then tell about 10 factors you will consider.
Repayment capacity.
I didn't get you.
Repayment capacity.
Purpose.
Repayment capacity, right?
Purpose.
Purpose, right?
In borrower details.
Come again.
Previous borrower details.
Okay.
What are the securities?
What are the securities? Security cover, yes.
Capital.
Capital. Yeah. What is the portion of the capital? What is the percentage of the capital capital to be contributed by the customer, how much they are expecting from the bank. Yes.
Pricing.
Pricing, yeah, one of the very important factors. So pricing only, on that only we were looking at what are the factors to be considered when you are doing the pricing, right? So while you are pricing, all the other factors what you mentioned will be taken into account. Yes.
Background of the customer.
Background of the customer, very important. What kind of a background? Whether they have, whether they have experience in the field or whether they are new to the field, whether they have, kind of solid management there. Yeah, go ahead.
Business risk.
Business risk, you will look at whether the business is sustainable, whether it can continue, whether they are doing well, what is their market share, right? Okay. When you look at the risks, what you have to look at also, you will come out with the better answers. What are the risks you will look at itself?
Financial risk. Security risk.
Yeah. You will look at the financial, financial side of it, you will look at, and the security side of it, you will look at, and the management side of it, you will look at. Right?
Market risk.
Yes?
Market risk.
Market risk you will look at, their succession, planning you will look at, right? So the factors, risk factors also can be, this is general questions, so that I mean that also can be mentioned. So when you're looking at the risk side of it, you will come out with a structured answer, right? These areas you will have to look at, right? So on those you will have to expand for a 10-mark question. I don't need to go into detail because we have elaborately discussed these areas. So basically those risks are very important, whether it is a business risk or whether it is a market risk or whether it is a financial risk or whether it is a management risk, right? Management risk will involve succession planning and all that kind of things, whether succession in place and all that. So those are areas where you can basically elaborate on. Right. So what are the adverse effects of a wrong loan structuring? Why it is considered import? So what are the adverse effects? You structure a facility wrong, right? Why it is considered important? What are the adverse effects? What do you think are the adverse effects?
Arrears in installments.
Yeah, pardon?
Arrears in installments.
Arrears in installments. Okay. It can result in arrears in installments, in the sense, I mean, non-payment payment of installments, like what we discussed, like a hardcore situation where customer takes the fund and then you give, where a term loan should be given, you are given an overdraft. So customer takes the money and then he pays only the interest. The amount becomes hardcore, right? The wrong structuring. Okay, then one. Go ahead.
Misusing of
Business.
misusing of funds.
Yeah, your voice is not very clear. I don't know whether other students listen here.
Misusing of funds.
Misuse of funds, yes, yeah, that's the reason. The hardcore forms because of the misuse of funds, partly, right? Either business loss so or else misuse of funds, correct? Even with a genuine customer, even customers with genuine interest, when you structure a particular facility wrong, you can put the customer into a difficulty, right? Put the customer into a difficulty. So like what we discussed here now, in place of, let us say somebody is putting up a you know, shop or business, or it's a warehouse. Say for that you go and give a overdraft. You go and give a overdraft and then say, okay, you put the warehouse, for that we will give overdraft. So eventually what happens is that from that directly there is no cash flows coming. So okay, there may be some overheads would have been reduced by way of rental. But what happens is that when you give a overdraft and then like what I told you, like I mean, it will end up in hardcore, and then he will service the interest. So when he only services the interest, what happens is that the capital portion of it, the reduction from the amount that is given, not happening. So at a later date, when you go and see that, I mean, okay, this is hardcore, you will have to pay the thing, then you can say that, I mean, I don't have enough cash flow to pay the loan. So this should have been earlier structured properly. How much from the current this one, you will have to give a loan only. You can't give a overdraft. You give a loan for construction, because from that you don't directly expect cash flows. So that from within the current cash flow, he should be able to pay the installment, which consists of capital and interest, right? So that is a wrong structuring. Now, like that, what happens is that for a LC facility, for example, let us say somebody is importing, his business turnover currently, or if you take the last 2-year period also, I mean, at any point of time, his LC outstanding is only 50 million. Let's say instead of 50 million, looking at the business and then at what level he operates, we go and give 100 million, right? We go and give 100 million. And he basically thinks that, I mean, I have higher limit, and then what I normally do, let's say he goes and imports. Right, imports, and then that particular additionally what without unplanned way what he imported, he gets stuck with that. Right? He gets stuck with that. The reason is not from the customer, reason is from us. We wanted to achieve our targets. We go and give a higher limit. Okay, instead of 50 million, you do, I will give you 100 million. This due to competition also we do. Some customer who is according to the business requirement, he is operating from a bank, he has limits and all that. The bank has properly assessed and given a limit. Some other bank will say, are you enjoying 100 million there? I will give you 150 million. Less than that trade. Come. So attract that. What happens is the customer finds that, I mean, he actually is not, other infrastructure is not ready for with that. Whether it is his shop, or whether whatever warehousing facilities, so whether the customer range or whatever, is not ready for the enhanced volume. But because the greediness given by the banks, competitor bank, he goes and imports and then gets stuck with getting rid of the stock, unable to sell it the way he wanted, and then that got stuck, and then so working capital facilities are getting stagnated. The bank is putting the pressure, and then he has to sell it in the market for a lower price than what he normally does, and then he has to compromise with profitability, and he falls into problem. So these kind of things, wrong structuring, right, can really put a customer into difficulty, right? That may be because of the customer's greediness. The other one may be misguided by the financial institutions. Many a time that happens. Financial institutions misguide, right? Many a time we identify the lending officers go and try to attract account from other banks by giving attractive thing, like enhancing the thing. That's a different matter. Okay, you are doing you are canvassing business, that's all right. But whether you justify that action with the customer's capability of doing that, operating at that level, And then whether are you sure that the cash flow will be generated? Whether are you sure the facilities will be serviced properly? That is where the problem comes. So what are those are adverse effects of wrong structuring. End of the day, what happens is that the effects are like, I mean, non-payment of the loan, like what you all say, defaulting loans, right? Loss of performing advances moving to non-performing, right? Sometimes loss of customer, sometimes customer losing the business, right? Pushing customer into a kind of a difficult situation, and then customer losing on his business, losing on its market standing. All this can happen because of a wrong facility or loan structuring, right? So that's why it is important. Why is risk weighting of assets important for students? Today I thought I will not go until 12:30. I will finish it before 12. So we will go on. I'm not taking a break. We'll go on. We'll discuss, and then I hope we will finish it early. So then next week, of course, like what I told you, a few on the IFRS 9 we will look at. Maybe I will touch upon on the Basel 3 balance, anything if you have to tell, and this impairment provision related some knowledge. With that, we will complete our sessions, right? Okay, so you may be wondering why no break. So we'll go without break. Right. So why is risk weighting of assets important for pricing a loan? Explain with examples. Now you tell me. Why do you think risk weighting of assets is important? That basically means what risk weighting of assets means. Your price to be adjusted according to the risk levels of the lending, right? Your pricing will be, kind of vary according to the risk. So why is risk weighting of assets important for a pricing of a loan? Explain with examples. Yeah, how will you answer? Yeah, go ahead. What do you understand by this? Don't worry about the correctness of your answer. Just go ahead.
For the unsecured loans, the interest rate is higher, and the secured loan, the interest rate is lower, and it will be depending on the realizability of the security.
Okay. Any other views? you must be able to connect with the capital requirements also, right? We looked at the capital requirements, capital allocation. Risk weighting of assets and capital allocation we looked at. For example, if you are looking at a gold loan, there you go in risk weighting is 0. So you don't basically you don't go and allocate capital for that, right? So gold loans, no capital. But if you say you are giving a commercial loan against, okay, stock mortgages or whatever, stock mortgages, you need to provide capital, right? Risk weightage maybe 100%, right? It may be 100%. If it's SME loan, giving SME loan, there is that for that amount you will be calculating. I mean, there's a risk weightage of 75%, right? So that means basically the 14.5% or 12.5% capital required by under the Basel III for that calculation. What is the amount you will take? You will take the amount of 75% of the SME type of, right? Other commercial loans, what you are given 100%. Some of the loans which are given under the category 150% also, right? So based on that, so this risk weighting of assets, right? So when you're looking at the risk weighting, the higher the risk weighting, the pricing of a loan also should be in line with that. That is where you must talk about risk-adjusted return on capital, right? So we looked at the RAROC model. RAROC model is risk-adjusted return on capital, RAROC. So under risk-adjusted return on capital, I mean, higher the risk weightage, your pricing also should be that. So that also will be, it has to be part of your, pricing strategy. In your pricing strategy also, it has to be part of your pricing strategy. What is the risk weightage, right? So that is the connection. Why is the risk weighting of assets important for a pricing loan? For loan, like risk weighting of assets is involved with providing capital adequacy, right? It's involved with making capital provisions. So the higher the risk, higher the capital requirement. So if the capital requirement is high, your tendency to price that particular loan is high, right? So that's the connection, right? So you can look at different. I mean, whether you can look at SME, how you are doing that, by your other commercial loans, how you are doing that, how you are doing with the gold loans. I mean, that those examples you can explain. You can mention and explain, and then this is a 5-mark question. You don't need to write a very elaborate answer. Okay, any questions up to now? Are you all okay? Are you all comfortable?
Yes, sir.
Okay, so now one more question paper we will look at next week, and I probably feel that with that we are done. This I could not prepare your this one, so I will do that next week. And this is something which is there for you to get a basic understanding. But then from this, I will prepare a small tute with the important points, and then we will discuss next week. right? So now, but you should understand that after 2018, the introduction of this SLFRS 9, it has brought in a huge change in the way our provisions are to be made, impairment provisions are to be made, because until then we were looking at the past, right? So the basic, I mean, the reason for developing this kind of accounting standards, IFRS, International Financial Reporting Standards 9 and all, came to be for the simple reason that you know that there was a financial meltdown, financial crisis in 2008 and 9. It started in US. At that time, lot of huge companies, like huge Fortune 500 companies, biggest in US, and then big in the world also, they came down due to the way some of the operations happened. And at that point, the Basel Committee, they felt that the current standards, accounting standards which are followed by these financial institutions, not really sufficient to capture those risks and prepare adequately. They thought that all what we are doing currently is that we are only looking at the past and do the provisions based on the past record. But we are not looking at the future, right? So the difference, basic difference between the old one and then now the IFRS or SLFRS 9 is that looking at the future moment of the business, right? And based on that, taking the decision. That's the basic difference. So earlier we were following LKS 39, right? Following LKS 39. Now it is SLFRS 9. So the basic difference between these two accounting standards are that the old standard is rule based, right? So the given rule, according to the rule, you calculate and make provisions, right? Historic basis, rule based calculation. Now SLFRS 9 is principle based, right? What is the principle? So it's a bit flexible, and in a way it's easy to kind of operate, right? LKS 39 is complex and difficult to apply, but under these SLFRS 9, classification based on business model and the cash flow, right? So they do a SPPI test, that means solely payment of principal and interest. Based on that, you do the classification, right? Classified based on the business model and nature of the cash flows. And then multiple impairment models were there under LKS 39, and then but then SLFRS 9 gives only one impairment model. And under the old model, own credit gains and losses not recognized. Under the new model, own credit gains and losses presented in two ways. That is, own credit gains and losses means, so you have an asset portfolio. From the asset portfolio, what you have, based on the nature of the asset portfolio, how do you take decisions on revenue recognition and impairment provision? How do you take decisions? So under the all this one, of course, if there is own credit gains and losses, those are recognized in profit or loss for fair value option, and liabilities, assets and liabilities I mean, based on the fair value option, only fair value option. But then here they are segregating that. They are segregating that under the new standard. Is that the own credited gains and losses they are presenting in two ways. That is other comprehensive income. OCI means other comprehensive income for face value option. Right. Other one, rest will come into P&L. So these two models are which are coming under this. It's a basic differences anyway. Don't worry about, much on that. Only for kind of information purposes I'm giving you. But next week on the portfolio I will touch on. Right, basically our bread and butter is that the loan portfolio. On the loan portfolio, how it happens, I can touch on. So the IFRS 9 deals with the business model. So business model basically, like, business model refers to entity, how, it is used to generate cash flow and all that, that model. So based on that model, model will be determined on the level that reflects how the financial assets are managed to achieve the particular business objective. Right. Now, here, the decision to be taken is like what business model qualifies for the amortized cost, what business model qualified for fair value through, like it's called FEOCI, fair value through comprehensive income. The other one is other business models. These are the three basically differentiations are given. When we take our loans, basically all our loans will come to this. What business model qualifies for amortized cost? This, under this only all our loans will come. Financial assets are at amortized cost are held in the business model whose objective is to hold assets in order to collect contractual cash flows. So this is our loans. Now our loans we will, given as a financial asset that's kept periodically, capital and interest being paid, and it has to be paid off. So that is the amortized cost. That's how that we are recognizing these things in the capital reduction, and then interest is recognized for the P&L account. So that goes to the P&L account. This is the amortizing cost, right? So amortizing cost, of course, basically, I mean, this is for all our loans on the IFRS 9. Basically, there will be a model. It is what is the opening balance, right? What is the effective interest rate, right? What is the interest rate paid, and what is the closing balance? So that is the basically is based on that formula only. The amortized cost is then I will give you some examples. So don't worry about what I am telling you now. So in the presentation I will put and give you, so that if this is something which you did not understand, don't worry, we will look at it at the next class, right? So then the other things which are, that I mean your bank of finance, financial institution is investing in bonds, treasury bonds, treasury bills, and all that. These things largely will go to the other categories, right? Those are taken for the purpose of either to keep, right? Whether to keep. So if a treasury bond, let us say you bonds bought and that kept in the business, kept with the bank, your bank, until maturity. So you know these treasury bonds and all that gives coupon according to the coupon rates. So you periodically 6 months or one kind of, you know, you get the return monthly or 6 monthly, or like, I mean, you know, the dividends have been paid, interest is being paid. So that you know, you keep on getting that, and you know, at the maturity you get the capital amount, but in the bonds, it's a financial asset. So that goes under amortized cost, like the loans and advances. These bonds also will go under amortized cost. That part of the bond where we decided that is kept for maturity, right? That is to keep. But there will be some which we will do both, buy and have that, and then it may be we will be getting the interest and capital portion also, we'll get the repayment, and then partly we will sell also, right? So that part only, the second one they are talking about, that fair value through other comprehensive income in the P&L account. You know, this is shown separately, fair value through other comprehensive income. So that part, of course, interest and capital and all that will be coming under the if your CI, fair value through other comprehensive. The other business models, of course, is not kept kind of, you know, like, I mean, you know, like it's not fully kept, and it is not partly being traded and partly being kept and all that. Under the second one, it doesn't come. The other category, any financial assets that are not held in one or two of the business models mentioned above, that is the other category. Basically, they are, of course, fair value through profit and loss account. Like, I mean, fair value means, I mean, what is the current value? Current value, any differences will be posted through the profit and loss account. So these are the few models which are used for the, you know, like I mean, identifying assets, and then for impairment purposes, what kind of amount you will take and all that. So more on this we will discuss in the next session. Okay. So for example, in this, you can go through this, but I will create one for you in a very simple way for you to understand. So in this particular worksheet, if you see that process for determining the classification and measurement of financial assets. So how do you, if there are instruments within the scope of SLFRS 9, whether contractual cash flows are solely principal and interest. If the contractual cash flows are purely principal and interest, yes. So if it is held to collect contractual cash flows only, yes means, yeah, that means a fair value option. It's called fair value option. That's like a loans, right? And that then it goes under the amortized cost way that will be treated. And in the sense, I mean, loans, of course, not fair value option. You don't take the loans and advances. You don't go and look at the fair value option, right? That is basically, you know, amortized cost only. Now, if a loan is there, it is being paid off, 100 million has become 75 million, you will only take 75 million. There is no fair value option. So it is amortized cost. If you are to take fair value option, so then it's fair value through profit and loss account means what? that any changes in that particular asset, if you take a bond, there will be currently, if the interest rates have changed, the bond value will be different. So that value difference will be adjusted through the profit and loss account. That's what fair value through P&L. Loans and advances, no, it is amortized cost, right? On the left hand side, when you find it. So on the other side, held to collect contractual cash flows and for sale, for both if it is kept. Held to collect contractual, now you think of bonds, treasury bonds. Held to collect contractual cash flow. That means whatever bond interest to come, we'll collect, and for sale we are keeping. If it is yes, if it's a fair value option, then of course, look at the fair value and then adjust the P&L. If it is not a fair value option, then fair value through other comprehensive income. It has to go. This is the way that, the entire asset base of the bank is going to be treated. So nitty-gritty is in this only in a very simplest form. I will try to put it in a few slides and I'll speak to you. That will be, circling around this only, but I will speak to you in a simplest way you will understand, right? Any question here? This actually gives a better idea for you. Like, few terms are like, I'm not going to test you, in depth on this. I'm only trying to give you an idea about SLFRS 9, and you need to understand in your institution, financial institution, the accounts are being prepared for various purposes. When it comes to your central bank purposes, central bank, provision purposes, like what we did, the provisions are calculated as per the thing what we studied, and then rates, amounts are applied and all that haircut rules are applied and provisions are created and provisions are to be kept. So that's number one. Number two is what? Reporting standards. These are International Financial Reporting Standards, IFRS. Sri Lanka SLFRS, Sri Lanka Financial Reporting Standards. These are prescribed by the Chartered Institute, and we prepare the accounts according to SLFRS to be in line with the international reporting standards, so that our companies are kind of competitive internationally too. So anyone who wants to come and invest, let us say in Sri Lanka, from any of the country overseas, they should be able to look at the financials and understand, because the standards what is maintained in their country and our country should be the same. That is the very reason they want to have similar reporting standards. That's how the SLFRS comes into being, International Financial Reporting Standards. On Sri Lanka, slightly tweaked on of that will be the SLFRS. That is the authority which is giving these standards is Chartered Institute, right? CS Sri Lanka, Chartered Institute of Sri Lanka. So, so then there is a difference from what we calculate and then provide, and then our accounts prepared for central bank purposes, and then reporting standards. Reporting standards different. The other one only I was telling that even in calculating the taxes, there is a different calculation being done for payment of taxes. So payment of taxes doesn't happen simply with your what you get on the net profit, and then on that percentage what the government wants you to pay, 28% means on that, it's not calculated that way. There are some adjustments to the profit and loss account will have to be done according to central bank's requirement, according to the Inland Revenue Department's requirement. According to Inland Revenue Department's requirement, you will prepare that and then calculate the taxes according to that. Sometimes your effective tax will be higher than the prescribed rate. Why? Because you are going and doing these changes in accordance with the Inland Revenue requirements. So these are the differences. Now, what I'm trying to say is that why SLFRS 9 is important for you is that you need to understand from your loan book, right? From your loan book, you all are making impairment provisions. If you all are making impairment provisions from your loan book, depending on various conditions, what are those? How you all are making impairment provision? That's where this SLFRS 9 takes the importance. So because Sri Lanka into preparing published accounts based on SLFRS or IFRS, then your bank also is preparing accounts according to this. Otherwise, it will be a kind of a violation. So then you must understand what is happening to your loan book, right? How you are calculating, right? So slightly a knowledge on the how you are treating the bond on that, your financial assets. Your important financial asset is your loan book. From the loan book, how you are preparing, how you are calculating what is the principle, and then how you are calculating your impairment provision. A little bit knowledge on that. So that's what is where we are coming to, right? Okay. To tell you again on this, you go through this and then keep with you, and then ask questions next time. And with my other slides also, we can again discuss. So any instrument with the scope of SLFRS 9, right? Anything, whether these are called financial instruments. I mean, within that, even our loans will come into this definition. Instrument within the scope of SLFRS 9. Then out of that, contractual cash flows are solely principal and interest. If the contractual cash flows are going to be solely principal and interest only, so I told you loans are like that. It is principal and interest only, right? That of course, yes, means held to collect the contractual cash flows only. If it is like that, yes. After that, if it's a fair value option, whether we are going to, the asset value going to compare with the market fair value. We don't do for the loans, right? We don't do for the loans. Then the amortized cost. Then the amortized cost calculation we will look at. This is basically what I am trying to tell you. Amortized cost only you are going to show in your P&L balance sheet. In your balance sheet, this is the amortized cost you are going to say as the financial asset. So what does go into that for your loans? Then the other thing only we were looking at, financial asset for a financial institution is not only loans and advances. There are the investments also. You are investing in debentures, you are investing in, you may be investing in treasury bills and treasury bonds and all that. Out of that, you look at the quality of individual instruments, right? This is a part of the treasury which they will classify, right? So the contractual cash flows are solely principal and interest. If it is not, no. Contractual cash flows are not only principal and interest. We say, then of course it is, you look at the fair value. Fair value adjustment will take place. The fair value, let us say for some bonds, you purchased at kind of 8%. The current rate is 6%. For example, current rate is 6%. So the in the P&L, what you do, the difference between the current value and its fair value, right? You will go and credit your P&L. It will be the other way around also. If you have purchased a treasury bond for, let us say, which is paying 6% per annum. Now currently the current rate is 8% per annum. That means I mean, there's a loss. 2% loss is there. Then you will go and debit your P&L. That's the adjustment you will do in the fair value adjustment in the profit and loss account. So that's what basically means it. So that part. The second part what we looked at is what? Held to collect contractual cash flows only. If it is not held to collect contractual cash flows only, then held to collect contractual cash flows in for sale. Now we keep it, I mean, you know, your bank will have treasury bills and bonds. When they want, they will sell it also. It comes under that, right? When they want, they will sell it. Now let us say you bought it at 10% interest rate. Currently it is 6%. Current market rate is 6% means you can sell it and then make a profit out of it. You can bring it because the 4% difference you can take to profit and loss account. So if it is that held to collect contractual cash flows and also for sale, if it is yes, whether it's a fair value option, if it is yes, then fair value through profit and loss account. So if it is not a fair value option, you are not going to value according to the market, you are just going to keep it, means then it will be a thing called fair value through other comprehensive income. That is the difference, right? That is the difference where this is the whole thing about your IFRS 9. And on this, like what I told you, our concentration is on the kind of amortized cost side of it, where via loans or advances we are given. Periodically, we will collect the principal and interest, and then we will, you know, we are keeping that only to collect the contractual, you know, interest and capital, and we don't go for fair value. We don't do fair value calculation on that, and so that we'll go for amortized cost. And amortized cost, how you will calculate, is where I'm coming to, right? That part only I need to cover with you when it comes to loans and advances. So for your knowledge only, I was telling about other instruments like bonds and all that when you are keeping, whether you are keeping that to collect the cash flows and also to look at the market, compare with the market and take it. If you are keeping that and then compare with the market, also fair value calculation and then do that, means yes, the fair value adjustment we will have to do with your profit and loss account. If you don't, if you keep the bills and bonds, you don't do fair value calculation. You don't do fair value calculation. You don't want to go and credit your profit and loss account, credit or debit. Then that part is going to, that amount is going into a call fair value through other comprehensive income. This is the whole thing which is about this IFRS 9, right? IFRS 9, like what I told you, we are loans heavily, we will be concentrating on the amortized cost. Are you all okay with this? Do you understand this? The amortized cost part of it, we will discuss. Are you okay? Or is it Greek? Why no one is talking? Are you all awake? Right, ask any doubts.
provisions and impairment refers to the same concept, or those are different concepts?
I didn't get you.
Impairment and provisions are same concept, or those are different?
Impairment and
Provisions.
provisions. See, the provisions what you are making, according to central bank's regulations, is based on the past figures, right? Past figures is what? Now 90 days not paid, 180 days, from 360 days we start, right? We start providing, at different stages we start making provisions that we do. But impairment provision is different, right? Impairment provision based on the future cash flows. We look at the future cash flows. Now, if you take this, impairment of financial assets is recognized in stages. There are 3 stages. Now, this is what your finance and accounts will do. Now, for that, you all will have to give the forecast, right? If there is no problem in a performing advance, and then you don't foresee anything during the next 12 months, for the next 12 months and beyond. It says stage 1 is as soon as a financial instrument is originated or purchased, or like financial instrument, you can say loan, 12 months expected credit losses are recognized in profits or loss account, and a loss allowance is established. This serves as a proxy for the initial expectation of credit losses. For financial assets, interest revenue is calculated on the gross carrying amount without deduction for credit losses. Right? The financial losses, interest revenue is calculated on the gross carrying amount. That's what will happen. That's the stage 1, right? As soon as the financial, right? Stage 2 is that if the credit risk increases, right? The stage 2, if the credit risk of a loan increases significantly and not considered low, full lifetime expected credit losses are recognized in profit and loss account. So there is a calculation. How do you calculate that lifetime expected credit losses? Right? Expected credit loss is an important term under this ECI, ECL, right? Expected credit loss. So full expected credit losses are recognized, and then there's how much has to be kind of provided will be mentioned. The calculation of interest revenue is the same as stage 1, right? Gross carrying amount. Right, the stage 3 is where if the credit risk of the financial asset, that means a loan, increases to the point that it is considered credit impaired. Right? Now, see, all this can happen at different stages of the particular central bank's guideline, like 90 days, 180 days, 360 days. So this is not dependent on that. This is independent of that, right? So these impairment provisions are independent of that. These impairment provisions are in addition to that, right? Keep in mind. So if the credit risk of a financial asset increases to the point that it is considered credit impaired, interest revenue is calculated based on the amortized cost, the gross carrying amount less the loss allowance. We'll have to calculate the loss allowance, which is the net carrying amount. Financial assets in this stage will generally be assessed individually. Lifetime expected credit losses are recognized on these financial assets. So these, our impairment calculation depends on all these 3. Like how do you segregate your loan portfolio among these stages, and based on that, how do you calculate the impairment provision? And impairment provision will be is going to be debit to the P&L, like for reporting purposes. Like what I told you, that will not be taken into account when you are paying taxes. When you are paying taxes, that is not going to be deducted. You are going to pay taxes according to what we earlier calculated without these things. You pay the taxes. right? But these are for reporting purposes. You will have to do that, and then your financial reporting, that the published accounts will be based on this. Right. So there are kind of, the impairment loss calculations for individual loans. How do you do? For a group, how do you do? Right? For a, like, I mean, under what circumstances you will do for individual, under what circumstances you will do for a group, all that has to be looked at. Right. So did you all understand? I told you individual loan and example loan to impairment calculation for a group loan, right? For a group of loans, how do you do? That is there, right? So you don't need to break your head, right? You don't need to break your head, but only thing you must understand these things. Yeah. There is a thing called IFRS 9, and the Banks and Financial Institutions Act making impairment provisions based on IFRS 9, and that is for reporting purposes, and that's how your profit and loss is reported, right? Reporting, I mean, that's how it is reported. This is independent of the provisions required by the central bank in addition to that, and your tax calculations are not actually dependent based on IFRS calculation. Before this kind of IFRS 9 calculation, your tax calculation will be done separately. These are the things you should understand, basically, right? So little bit I can, further on these, your loan portfolio specific information, important terms, how that is calculated, some insights I will present to you. But if you go through this, even you will understand. If you don't understand, don't worry. Right? I do not want to go further on this. Any questions? Any questions?
So are we calculating this impairment provision for performing loan portfolio, both performing and non-performing portfolios?
Yes, we will have to. Non-performing portfolio as a whole, it will be done. Performing, non-performing, all we will have to calculate, yes.
It is meaning that instead of that central bank provisioning, in addition to that, you will have to calculate this impairment provision for the non-performing portfolios too, no?
Yes. You'll have to, that's why now, like, I mean, your profitability, showing your profitability, and then, based on that, you're paying the taxes and all that will be one set of accounts. And reporting standards you have to prepare, you have to include the IFRS calculation. So IFRS 9 based impairment provision has to be part of it. This is in addition to that. So this gives you that, how do you different terms works, and then, how do you calculate? I mean, in these tools you will find that, I mean, how do you, kind of, these are the important terms. Probability of default in the next 12 months, how, right? I mean, that based on that lifetime probability of default, loss given default, I mean, based on that, how do you calculate? I mean, these terms only I want to, explain in my next presentation to you, right? So those are all based on these calculations. You need to understand. I mean, not really important, but then you should know what your bank is doing. So those are the things I will do for the next session. All right. Any more questions? Any more questions? IFRS 9, don't worry. What you understood, okay. Whatever you haven't understood, make a note of it and keep it. Next week we will discuss, and this part, the simplified version of this also I will give you next time, and then we will discuss and do that, and then let me come out with another question paper just to quickly discuss the question paper. Are you all okay? Are you all okay? Ask any questions. Ask your questions up to now. What we have done, whether from the question paper or whether it is from this. So ask your questions. I will answer that, and then we will call it a day. With this tute, I do not want to continue with you, because you will get a little confused when too many terms are being mentioned here. So I need to extract the important things and then put in. I want to discuss with you. That I will do with the next class. No more questions? Okay, shall we wind up for the day?
Okay.
Right. Okay. If you don't have any questions, let's wind up for the day. And please do go through these. You can make sense out of it. And simpler, explanation I will bring it in addition to what I told you today. And for you to understand how these impairment calculations are done. Right. So anyway, you all are getting some time off today, the class also. So with next class, we are, winding up our lectures. And then thereafter, I don't know, when is your exam? Were you told when is your exam?
No, sir.
Not yet, no? Right, okay. Anyway, I'll ask the directors when the exam is going to be. So then you can go back into your preparations for the exam. Right. With that, let me wind up. We'll meet up next week. Have a nice weekend. Take care.
Thank you, sir.
Bye.